Welcome back to Up to Finance, where we simplify the world of finance and investing. If you've ever wondered why some investors succeed while others struggle, the answer often lies in how they structure their portfolios. Today, we're diving into a topic that every investor, whether you're just starting out or looking to refine your strategy, needs to understand: building a diversified investment portfolio. By the end of this video, you'll have a solid understanding of how to build your own diversified portfolio and why it's one of the most powerful tools in your financial arsenal. Let's start with the basics. Diversification means spreading your investments across different assets, industries, and geographies. The idea is simple: don't put all your eggs in one basket. If one investment fails, others may still perform well, helping to protect you from total loss. The key here is balance. Now, you might be asking, why is diversification so important? Well, let me show you with a quick example. Imagine you've invested all your money in a single tech stock. If that stock crashes, like what happened during the dot-com bubble or the 2008 financial crisis, you could lose a significant portion of your wealth. But if your portfolio includes a mix of stocks, bonds, real estate, and commodities, even if one asset drops, your other investments might still be doing well. Diversification protects you from the unpredictable. It's about increasing your chances of success by ensuring that your portfolio isn't entirely dependent on one asset class. And don't forget, diversification doesn't just mean spreading out your money into different types of investments. It also means mixing different sectors, regions, and strategies within those categories. So, how do we build a diversified portfolio? The first step is understanding the different types of assets you can invest in. Let's go through each one. First up, stocks. Stocks are shares of ownership in a company. They offer the potential for high returns, but they come with higher risk. The stock market can be volatile, and prices can change drastically in a short time. That's why it's important to diversify within stocks. For example, you can spread your investments across different sectors, such as technology, healthcare, finance, and energy. You can also invest in large-cap companies for stability or take a more aggressive approach by including small-cap companies with greater growth potential. Next, we have bonds. Bonds are essentially loans you give to governments or corporations. In return, you receive periodic interest payments and get your principal back when the bond matures. Bonds are generally safer than stocks, making them a great way to add stability to your portfolio. When it comes to bonds, you have government bonds, corporate bonds, and municipal bonds, each with its own risk and return profile. Now, let's talk about real estate. Real estate offers another form of diversification. You can invest in physical properties, or you can invest indirectly through real estate investment trusts, REITs, which allow you to invest in property without owning it physically. Real estate can provide both income through rent and potential capital appreciation, plus it often has a low correlation with stocks, so it can be a great hedge against market volatility. Then, there are commodities. Commodities like gold, oil, and agricultural products can act as a hedge against inflation and currency fluctuations. Commodities can be highly volatile, but they often behave differently from stocks and bonds, which can provide a balance in your portfolio. They're a good option when you want to add more protection against the risks of inflation or market disruptions. Lastly, we have alternative investments. These include assets like cryptocurrency, hedge funds, private equity, and collectibles. While these assets can carry high risk, they also offer the potential for high rewards. They're often less correlated with traditional markets, meaning they can help protect your portfolio during periods of economic uncertainty. Now that you understand the different types of assets, let's talk about how to allocate them. This is where asset allocation comes into play: how you divide your investments among different asset classes based on your financial goals, risk tolerance, and investment timeline. For example, a more aggressive investor might have a portfolio heavily weighted towards stocks, particularly growth stocks, with a smaller percentage in bonds and real estate. A more conservative investor, on the other hand, might have a higher proportion of bonds and real estate, with only a small portion in stocks. Asset allocation will vary based on your goals, risk appetite, and time horizon. But remember, there's no one-size-fits-all solution. Your allocation should reflect your individual needs and objectives. So, how do you determine your risk tolerance? Are you willing to take on more risk for higher returns, or do you prefer stability and consistency? If you're investing for retirement in 30 years, you might opt for a more aggressive allocation, knowing that you have time to ride out market fluctuations. But if you're planning to retire in 5 years, you might prefer a more conservative portfolio to preserve your capital. It's important to note that diversification doesn't just mean spreading your money around different asset classes. You should also consider diversifying across different regions. Global diversification, investing in both domestic and international markets, can help protect against risks specific to one country or region. By including international assets in your portfolio, you can take advantage of growth in emerging markets and reduce the impact of a downturn in any single economy. But here's where it gets tricky. Even a well-diversified portfolio needs regular monitoring and rebalancing. Over time, certain assets will outperform others, and your asset allocation might get out of whack. For example, let's say you started with a 60% stocks and 40% bonds allocation. After a strong year in the stock market, stocks might make up 70% of your portfolio, while bonds shrink to 30%. Rebalancing means bringing your portfolio back in line with your original allocation. By selling off some of your top-performing assets and buying more of the underperforming ones, you can maintain the right balance and avoid overexposing yourself to one asset class. Rebalancing can be done once a year, but if you experience significant changes in the market or in your personal circumstances, you might need to adjust more frequently. The goal is to maintain a portfolio that stays aligned with your long-term objectives and risk tolerance. Building a diversified portfolio can seem like a complex task, but it doesn't have to be overwhelming. Let's break it down into a few simple steps you can follow. Step 1. Set your financial goals. Are you investing for retirement, a down payment on a house, or just growing wealth? Your goals will help determine your asset allocation. Step 2. Determine your risk tolerance. Are you okay with more risk for potentially higher returns, or would you prefer a more stable, conservative approach? Step 3. Choose your investments. Once you know your goals and risk tolerance, you can select a mix of assets like stocks, bonds, real estate, and commodities. You can also choose to invest through ETFs or mutual funds to give you exposure to a variety of assets within each category. Step 4. Rebalance your portfolio regularly. Review your investments at least once a year to make sure they're aligned with your goals. If your portfolio has drifted too far from your original allocation, it's time to rebalance. Before we finish, let's take a look at some of the common mistakes investors make when building a portfolio. One common mistake is overconcentration, putting too much money in one stock, sector, or asset class. Over time, this increases your risk. Another mistake is chasing hot trends, investing based on short-term hype or speculation. While this may seem exciting, it often leads to losses. And finally, don't ignore costs. High management fees and transaction costs can eat into your returns, so be sure to choose low-cost investment options like index funds or ETFs. So there you have it, your ultimate guide to building a diversified investment portfolio. Diversification is a powerful strategy for managing risk and increasing your potential for long-term growth. But remember, it requires thoughtful planning, regular monitoring, and discipline. If you found this video helpful, make sure to like, subscribe, and hit the notification bell so you never miss out on more financial tips and strategies. And of course, feel free to leave any questions or comments below. I'd love to hear from you. Let's keep the conversation going and continue building wealth together.